Well, welcome back to Finance Uncut. On today's episode, inflation out of control and interest rates to 7%. And coming in from the Wall Street Journal, US inflation, I think they mean CPI, hit 7% in December, fastest pace since 1982. And Peter Bookvar makes a good point here. He says, again, the BLS is badly miscalculating rent component by saying OER, or owner's equivalent rent, was up 3.8% year on year, and rent of primary residence was higher by 3.3% year on year. Apartment List said this week that 2021 rents were up by 17.8%. If the latter was punched into today's calculation, CPI would be above 10%. And that's because owner's equivalent rent, and similar to Australia and other places, is it makes up over 25% of the CPI number. So when you lie about that, CPI, then, and once again, if you have a look at ShadowStats, 15%. So with the highest CPI number since the early 1980s, talk about a misery index. And for all those people that push for government intervention and central banks creating more reserves, funding government deficits so government can create UBI and all these different programs, generally come from the poor and the middle class folk, in my opinion. No, look, I could be wrong. But that's what I see. Or at least people who claim to represent that demographic. Yet inflation hurts the poor the most. It hurts the poor and the middle class the most because they don't have financial assets. Inflation's great for those that hold financial assets. But those who don't, and that's predominantly the poor and middle class, this, when you have your essentials that you've got to buy each and every day, which the poor and middle class do, that hurts them. That hurts their bottom line. That hurts their back pocket. But the rich, this don't matter. This don't matter. But they're getting rich on the other end because they own financial assets. And this chart here shows that the Fed is clearly the most reckless Fed ever. So this is real interest rates. The federal funds rate minus CPI, and it's the lowest it's been in since 1955. From this chart, I haven't had a look at a chart going back over the last 100 or 200 years, but I mean the Fed was created in 1913, so I guess we could go back to there. But now people will say, "Oh, it's not the Federal Reserve. They just create bank reserves." Yeah, okay. So the federal government have been doing the massive deficit spending, and it's not just in the US; it's right across the world. But it's central banks that are buying huge proportion of, the outstanding bonds. There's a shell game there with the dealer banks. Who cares? At the end of the day, the Fed is monetizing a lot of the, creating new currency units through bank reserves, but those bank reserves are being spent by the federal government into the economy. And at the same time, we close businesses down and we create less supply of goods. We have supply chain issues. And I mean, people think this is the peak. I don't think so. Now, this chart is actually before the latest CPI. So this is CPI at 6.8%, not 7%. But if you have a look at and compare CPI versus the Fed funds rate, when it was last this high, the federal funds rate should be over 7%. Should be over 7%. Now, can you imagine if the Fed raised rates to 7%? What that would do to asset prices? Now, there's people out there that believe that they will raise it to 7%. That they'll do what it takes to fight inflation. Now, I don't think they will. And here's the thing. Usually, you fight inflation because people are borrowing from the banks. So there's money creation through the banking system, or currency creation through the banking system. I've argued this inflation has been created through deficit spending, through federal government deficit spending, monetized by the Fed in a large proportion. So raising interest rates, I don't think is going to have the impact on inflation or CPI, as long as the federal government or federal governments around the world continue deficit spending, move towards MMT, whatever. It's not going to cool people borrowing from banks, because most of this CPI has come from federal governments, not from the traditional, currency creation through banks. Sure, you look at home loan lending, yep, especially in Australia, it's gone vertical. So high interest rates will have a big impact on asset prices. But CPI, the consumer stuff, I don't think it's going to have an impact on that. I think, look, I guess we'll find out soon enough, won't we? And here's an interesting chart from DoubleLine, from the Real Bond King, Fed funds rate and wage growth. And so have a look at where wage growth is going and where the Fed funds rate is. So the big debate now is, where do central banks go? Do they raise rates to tame CPI? Do they not? We've just had, I think it was the IMF has just come out and said, expect for huge volatility, and we need to juggle, raising rates to fight inflation, but also recovery of the economy. Well, the economy is sick, and just simply pumping more debt into the system ain't going to fix the patient. Unfortunately, there's some pain to have. If we really want to get a healthy economy, we need to take some pain first. But I don't think politicians and central planners will like that and will go that option. So the question is, do they fight inflation? Do they fight CPI? Do they fight wage growth? I think they'll raise, and they'll raise a little. And I think that negative real rate will remain in negative territory, deep in negative territory. I don't think they're going to raise all that much. Not significant enough to do any real damage. I don't see them raising the overnight rate to 3, 4, 5%, let alone 7%, where historically they probably should be. And why is because since the global financial crisis, they have stuffed up. Central banks, the Fed has stuffed up. They have kept rates too low for too long, and they've created too much bubbles in asset prices. And now I guess they've got the choice. Do we basically default on the currency, on the dollar, or do we default on the debt and on asset prices? So we can't save both. We can't save the dollar and we can't save asset prices, in my opinion. One is going to get smashed in this decade ahead, in the years ahead. So what do you guys think it's going to be? Do you guys think it's going to be the dollar that gets smashed, or do you think central banks will act, and do you think asset prices are going to be smashed? Or do you think we can save both of them? Love to see your thoughts and opinions in the comments below. If you like this video, guys, please hit that like button. Really do appreciate it. Take care, and I'll see you again on another episode of Finance Uncut.